This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go! Help attract more borrowers and build a more resistant loan portfolio. Payment Guard Insurance from TruStage is a first-of-its-kind insurance solution designed for digital lenders to do just that. Visit www.trustage.com/payment-guard to learn more and talk with a member of the TruStage team. Hello, and welcome back to Fintech Recap, everyone's favorite podcast where we recap what's happened in fintech the last month or so. I am joined, as always, by the Carmen Sandiego of fintech, as I like to think of him. We never know where in the world he is. Jason Mikula, publisher of Fintech Business Weekly. Jason, how are you?
I'm doing well. I was just thinking, it feels like it's been eons since I saw you in New York, but that was like literally less than a month ago.
That is true.
I swung by the house to repack my suitcase in the Netherlands, and then I was in Istanbul for a couple of days. But now I
saw that.
I am here. There is no work-related travel until, at this point, actually until like September. Like there's some TBD, some schedule negotiations. I think I will see you at Finovate in New York in the fall.
Yes,
so that is exciting.
Yes.
But yeah, looking forward to actually enjoying spring, summer here in the Netherlands, because it's really the only time it's nice enough to want to be outside.
Well, enjoy it. I imagine like fields of tulips. Obviously, you have the windmill just down the road. There's the canals, the whole thing. So I am very, very jealous. Listeners should know that when Jason and I saw each other in New York a couple of weeks ago, which I agree feels like a million years ago, Jason surprised me with a gift that he had been carrying around in his backpack that he brought all the way from the Netherlands for my kids to play with. They are very much enjoying that. Thank you. You saved me on that front, and now I'm going to have to find a way to ambush you with a gift of some kind.
Yeah, no more emergency airport presence. That's usually, now I understand, like when my dad would go on business trips to like wherever, Hong Kong or Taiwan, like in the early 90s, and would just come back with like the worst, weirdest toy. And you're like, what? Now I get it. I understand.
No, it is very, very true. Your toy was a hit, but I will say that the problem with having kids and bringing back souvenirs is A, they expect souvenirs every single time. And B, at least at this age, they don't understand that a souvenir isn't like a present from your wish list. It's like a thing that I could find when I was in this weird place. And so like, I actually brought them back some pretty cool stuff from the New York Public Library because they have this like great gift shop. And they were just like, literally, they were unwrapping it, grabbing the thing and throwing it over their shoulder and looking for the next thing that was like actually the Lego or the toy they wanted. So I need to break this habit, Jason. It's not going well.
Yeah, I mean, I don't know. You could take them on a trip to BaaS Island as as a little incentive to learn more about what you do.
I'm not taking my kids to BaaS Island until it is much, much, much safer and better funded than it is today. But that is an excellent segue, as always, Mr. Mikula. Our first story, as listeners might anticipate, is a return to BaaS Island, where our embedded reporter has been surviving on coconuts. I think he's learned to fish off one of the keys off to the side of the island. He's doing what he can to survive. Mr. Mikula, give us the status report on BaaS Island.
Okay, we'll stick to the two bigger stories in this realm in the past month or so. Number one, Synapse bankruptcy, although as I think Synapse co-founder CEO Sankeet Pathak pointed out or argued on Twitter, on social media, the Chapter 11 filing, at least as they explain it, was basically a structural mechanism to facilitate the deal, which is selling, for all intents and purposes, all of Synapse's assets to a payment processor, payment infrastructure company called TabaPay for $9.7 million. That includes Synapse's broker-dealer license and Synapse's state lending licenses. So something that's interesting about the Synapse story, particularly in relation to the direction some of the other middleware companies have gone, is that Synapse really doubled down on sort of trying to centralize things in its own offering, and in a lot of ways really did, particularly as a transition to this broker-dealer model, for lack of a better word, sort of stand in between the fintech clients and underlying bank partners, which sort of everyone else has moved the opposite direction. And now we're saying things like we sell software to banks, or I was actually listening to a podcast with one of the middleware CEOs just before this, who actually now described the offering as comparable to Fiserv, which I found quite interesting. I suppose if it's tantamount to a core, perhaps it could be supervised by regulators under the BSCA, but we will leave that for another day.
Shout out Kia Hazlitt. Yeah.
I've digressed from my main point. So Synapse filed the strategic Chapter 11 bankruptcy, sold assets to TabaPay for just shy of 10 mil. Per the filings, Synapse, this is also quite interesting and noteworthy, settled its dispute with Evolve. So folks will probably remember there was some disagreement about a potential shortfall of customer funds, Evolve trying to increase the reserve amount that Synapse needed to set aside to cover potential losses, a lot of unhappy feelings. So this settlement, pending approval by the bankruptcy judge, resolves that, with Evolve agreeing to cover any shortfall in FBO accounts, so in customer funds, and paying the Synapse bankruptcy estate $2 million. When you look at the secured and unsecured creditors, it actually seems like everyone might walk away more or less whole, depending on how things play out. So Synapse owes $1.5 million to Silicon Valley Bank, aka First Citizens.
It's Citizens, actually, I think. But anyway, go ahead. Yeah.
$7.2 million to Triple Point, and an additional $4.3 million to unsecured creditors. So sort of depending on how things net out, like it looks like more or less, certainly the secured creditors and probably, the majority of the claims of the unsecured probably get repaid. The dispute with Mercury is ongoing. So yeah, I guess the estate will continue fighting for, I think it was as much as $36 million. Mercury is still suing, I guess, the bankruptcy estate for $30 million. And I'm trying to think if there's anything else particularly noteworthy. There's sort of two other interesting bits worth calling out. Per Synapse's filings, at one point, the company had a term sheet to raise $100 million in capital and intended to buy a bank, which I find I'm a little skeptical of that, but saying that it was vetoed by an investor director, and that there were two other offers besides TabaPay's to acquire Synapse's assets, but those wouldn't have supplied adequate money to pay back secured creditors. So I think they were stock-only deals as opposed to a cash deal. Quickly, our other favorite middleware company, Solid, has settled its lawsuit with its Series B lead investor, FTV, with the headline basically being Solid agreed to buy back FTV's shares at a hefty 56% discount. There was one very kind of weird bit in those filings, since I am now just like court filing master.
You are.
It's bizarre and like weirdly addictive, but yeah.
You were referenced in one of these filings, weren't you? I seem to recall a tweet about that.
Yes. Yeah, I was, as a disreputable one-man blog. But weird bit in the Solid filing that it sets aside up to $300,000 for Synapse's former head of finance, who was a, I guess, sort of
like witness. Solid's former head of finance?
Yeah. Solid's former head of finance, who was a, I guess, sort of like witness or testified about some of the sort of stuff related to their accounting. And it said this $300,000 is for legal issues arising from, his interaction with FTV, his employment at Solid, anything related to the settlement, or related government investigations, which I sort of asked around some of my lawyer friends, and they flagged this sort of like prepaid legal slush fund is quite unusual. It seems to suggest that there could be some additional investigation like related to these underlying matters, but that of course is completely speculative. That's the report from BaaS Island. What are your reactions to that, Alex?
Well, if I had to characterize just in sort of island terminology, it seems like all of the tribes have sort of maybe retreated to their corners for a moment at least. So there's somewhat of a temporary peace on BaaS Island. I don't know. I guess generally speaking, I think it's good news that the Synapse thing is being resolved. The creditors seem like they'll walk away relatively whole, as you were saying. I'm guessing the equity holders are not going to do quite so well out of the whole situation, meaning kind of get marked down to zero, which probably is something they were anticipating for a while now. And it's interesting, when the Synapse news kind of finally broke, there was, as there tends to be a lot of times on fintech Twitter, kind of a retrospective of like, it's like, I mean, not to be too grim about it, but, in the Oscars, when they do the reel of like all the people who've died, like, and they do the big like retrospective and they show their pictures and stuff, there's a little bit of that kind of talking about the fact that Synapse was one of the first sort of BaaS middleware providers, and they were very early to this. And I think you pointed out that they may have been the sort of inspiration for Angela Strange's "every company will be a fintech company" sort of mantra, which was one of the guiding phrases for the last 5 years or so of fintech. And, I think it is interesting because as I was thinking about like kind of how do you put Synapse in context of everything that's happened, one of the things I'm probably guilty of when I think about this stuff or write about this stuff or talk about this stuff is I'm very hung up on the idea, like the concept. Like, is this a good idea? Does this make sense conceptually? And, some ideas are better than others. I like to joke that there's really no new ideas in financial services because for thousands of years, smart people have been trying to innovate around money. So it's pretty difficult to come up with something truly original. But the thing that I think ultimately drives the success of this stuff is timing and execution. And I think when I think about Synapse and then Solid to a similar degree, I think timing and execution are the things I always keep coming back to. And in Synapse's case, I think there are a lot of things they tried to do that from a timing perspective just didn't end up working out well. And it is kind of interesting how they've cycled through, as you were saying, different types of models. They've been sort of unapologetically like, we want to be in the middle of all of this. They've gone and gotten state lending licenses. They had that broker-dealer license. So they've definitely been, I think, forward thinking on a lot of this stuff. Now, that forward thinking might be too far forward. And I think the snapback we're seeing on the regulatory side suggests that they were way out over their skis from where regulators ended up being. But there's an element of like bad timing or sort of thinking too far ahead about how the market might evolve. And then the other thing that I think is true in both the case of Synapse and Solid is just kind of your standard like execution. Are you running a good company? Are you making sure all the accounts are reconciled? Are you staying in good terms with your partners and your investors? Like there's just sort of a discipline to running a business part of all of this that is pretty boring. And I don't think a lot of people talk about it. I'm not even really sure a lot of like early stage investors even think a lot about it because you're, giving millions of dollars to a 24-year-old and just sort of hoping that they're going to turn out to be an adult that you can trust with that money. And I think it turns out that a lot of the companies that you and I talk about or write about, we can't see into those details any more than anyone else can. And so it's kind of hard until some of these stories start to come out trying to figure out. I've seen some people talk about it in terms of like good actors and bad actors. And I think a more nuanced way of thinking about it is which are the people who are going to be able to run businesses like grownups, for lack of a better turn of phrase, and which ones aren't. And to me, in some ways, that seems to be more of the determining factor for who's sort of making it through this current tumultuous period. I don't know. How do you think about that?
The good actor versus bad actor paradigm. I mean, when I hear the phrase bad actor, to me, that necessarily implies like bad intent.
Right.
I always go out of category and point to this example, but like, I imagine that if you asked Elizabeth Holmes at Theranos, like she really believed what she was doing.
Yeah, there's very little bad intent for the most part, it seems like.
And didn't, self-conceptualize like, oh yeah, I'm going to go run this scam and like get Jim Mattis on my board so I can get all this money. Like, I don't imagine that that's how that scenario unfolded. Similarly, in our space, I really 100% do not think any of the players were like, oh yeah, I'm going to set up this company and go raise VC funding so I can like run some kind of scam. I think
and then like declare bankruptcy at the end. Yeah, like this was not the plan or the intent, obviously.
I mean, I think your point around, is this a management team who can and is willing to run this business like an adult, is probably the much more realistic frame, right? And particularly if I'm thinking about this sort of middleware space where, as far as I know, still none of these companies, the ones that still exist as standalone companies, as far as I'm aware, are profitable. If you're making that decision as the founder, CEO, I mean, even the board really of this unprofitable middleware company and saying, well, we have X million dollars. Should we spend it on this like fraud and KYC vendor? Should we spend it hiring more compliance people? Or should we like throw a big party at Money 2020 to attract new clients?
Yeah.
You can start to think about how in this sort of time constrained and more importantly, like capital constrained matrix, how all of
Yeah.
a sudden you might be making decisions that at the time, feel like they're critical, right decisions to, even preserve the chance of the business sort of like raising another round and continuing to go versus like making the expensive investment that might not directly be revenue generating.
No, I think that's exactly right. And when I say this, I don't want to sort of just pin everything on the founders or the management team, right? Like this is an ecosystem. And I think to your point about, throwing lavish parties at Money 2020, like there were a lot of bad incentives in the overall ecosystem. And, a lot of these disputes that are happening, like the board of these companies is, responsible for this stuff too, right? Like the advice and requirements that they were giving to the founders that they were investing in, those weren't always really being well run either. And a lot of that, I mean, I've heard from a lot of founders that when the macro environment changed, suddenly their entire relationship with their investors and their boards changed in a way that I think created a lot more contention and problems and things that came out of that. And that's not all on the founders, right? That's also on the investors and the board of directors and all of those things. So I do think that we are kind of going through this period, and other people have talked about this, of just shaking out a lot of that nonsense. And, the companies that, at least on the BaaS side, are continuing to limp along, and we'll see sort of what the long-term view of the space ends up looking like. It seems like those are the companies that have managed to maybe do slightly better job in walking the line on some of those decisions, which again, to your point, are tough decisions that there's not always an immediate obvious right answer, particularly when everyone else in the ecosystem is doing this other thing. So I definitely am somewhat empathetic to that. But at the same time, I think, and you've done a lot of reporting on some of these companies. I mean, this was always where we were going to end up with Solid and Synapse. At least for the last little bit, it seems like this is kind of where we've been headed.
No, for sure. And I'm cognizant that hindsight can be 2020, not always. And it's very difficult. I wasn't in those shoes or in that room, those rooms in, whatever, 2020, 2021, where if you were one of these middleware companies and you had a zillion startups knocking on your door saying, hey, we want to become clients. I understand it. Of course, it's hard to say no to like that revenue opportunity.
Well, especially when your bank partners are like, cool, bring them on. Like, I mean, it's not like the banks were necessarily, I mean, you mentioned the E word, like Evolve was right in the middle of a lot of this stuff too. And they weren't exactly, putting a lot of, expansive guardrails around this at the time.
But I mean, I suspect that we have not heard the end of this sort of wider like BaaS reckoning story. But it feels like maybe we're at like an intermission, like maybe we're halfway.
That is exactly, I think, the right. I mean, we've switched analogies because now we're in a theater rather than on a desert island. But no, I agree with you. I think it does feel very much like, yeah, there's kind of this big breath that everyone is taking. And I was going to ask you, like, a lot more consent orders coming. Like, what is the next shoe to drop or thing we should be kind of thinking about? Because I agree with you. It feels like intermission, but it's not the end.
I'm sympathetic to folks on the fintech side, on the middleware side, who say things like, we just want the regulators to give us a rule book. On the flip side, I think they're likely to be disappointed if that is what they are waiting for.
I agree.
I mean, Yumi and Kia can talk about the BSCA as much as we want to, but until such a time as regulators actually exercise that authority to directly supervise some of these technology service providers, which like maybe they are right now and we just don't know. I think that
it's not something that gets disclosed. Yeah, so it's hard to say.
I think if folks in the space are waiting for a rule book to come down from the OCC, like they're going to be disappointed, right?
Yeah.
What we have seen, including the updated interagency third-party risk management guidance, due diligence guidance, and a whole slew of speeches from different regulators, which I think you read probably more closely than I do.
Yeah, I read them very closely. That's the one. That's the one I've gotten good at parsing. Yeah.
It's like, I think that they, collectively, like the Fed, the FDIC, and the OCC, like have somewhat joined hands and like
Yes.
have made a point and are, likely to continue to make a point through how they're approaching supervisory and enforcement with their respective banks. And
Yeah.
I think like that's the story. Like if you're sitting around waiting for, this is how a neobank should work with a middleware guidance from the OCC, like you're going to be disappointed. I imagine there will be more consent orders. I mean, Green Dot, I think specifically disclosed in a SEC
Yeah,
filing
one's coming.
that is negotiating one. I mean, I will resist the urge to name anybody. Like there's a
Yeah.
handful of other banks that feel like they have quite a bit of exposure that at least haven't publicly received an order yet. So like, I don't think this is over. And then there's also the question of like, is the current model sustainable? How many banks are going to stay in the space or newly get into the space? How many may consider exiting? And then what is the long-term role of middleware? Is it a standalone function? Is it something that's like part of a core offering? Or is it sort of built into the bank a la Column, Lead, Cross River, and so on? So I mean, there's still sort of unanswered questions here that I think will probably take another, frankly, potentially another couple of years to hash out, depending on how the market evolves. We need a new word for that, by the way. But
I know. It's unfortunate that that's such a useful word for analysis purposes because, it has a double entendre. Jason, should we jump to our next story?
Let's do it.
Okay. All right. So next one is Pay by Bank. So you might have seen the news that Uber will be using Link, which is Stripe's sort of embedded checkout functionality, to allow customers to securely and instantly add bank accounts without leaving the Uber app. So the saved bank details can then be easily reused, much like a card on file, for future purchases with Uber. So I thought this was interesting. You've probably seen it's kind of been somewhat ubiquitous on Twitter. Our friend Simon Taylor has been tweeting and writing a lot about it recently. Pay by Bank is having a bit of a moment in the US right now. Adyen, I saw, was talking a lot about it, both in the US and elsewhere. Stripe is obviously pushing on it in a bunch of different places through Link. There was an announcement that Tink, which was acquired by Visa, is now officially coming to the US. Tink, for those who need a reminder, is an open banking platform somewhat comparable to Plaid that Visa moved on to after they were prohibited from buying Plaid. Even JP Morgan Chase is playing with Pay by Bank through a partnership with MasterCard and Finicity, where they're trying to enable pay by banking functionality, I think specifically aimed at sort of bill payment and recurring large payments, while at the same time also vociferously arguing in their comment letters to the CFPB that open banking should not include payments as a capability. So they're preparing for both worlds, regardless of what happens, as the biggest players tend to do. And Jason, I'm going to be honest with you, I'm a little torn on Pay by Bank. And the reason that I am is that I can see it kind of from a bunch of different sides. So if you think about it from the merchant side of things, obviously lower cost payment rails is generally a good thing. However, one of the things I always try to remind people whenever we talk about merchants and retailers and what they're doing around payments is that Walmart and Target have a very different set of priorities than pretty much everyone else who sells stuff. If you're Walmart or Target or Amazon, you are big enough and at a scale where suddenly you can start to get sort of obsessed about your payment acceptance costs. And in fact, if you can find someone who loves you in this world as much as Walmart hates interchange fees, you should stay with that person for as long as you possibly can. Because like Walmart despises paying interchange fees, and they've made that abundantly clear over the years. Most merchants don't really care. And in fact, the biggest problem that merchants typically try to solve through payments and other types of financial services is how can they sell more, right? Which was the initial goal in accepting credit cards and debit cards. It's why buy now, pay later took off. Like helping most merchants sell more is much more important than helping them reduce their payment acceptance costs. So it's important, but it's not always necessarily the number one most important thing to all merchants. By the same token, it's kind of a clunky experience. I mean, for all of the, kind of fraud and chargeback challenges that merchants have with credit and debit cards actually work pretty well. Like people know how to use them. Cards are being embedded into digital wallets. Lots of places already have cards on file. And swapping that out with a bank account is kind of weird. Typing in your checking account and routing number, I don't know if you've ever done that when making a payment. It's not like super fun. It feels kind of weird. It's a little scary because, hopefully consumers know that they don't have quite the same level of sort of fraud and chargeback protection as they do when they're using a card. Now, open banking can make that a little bit smoother. And as I referenced, a lot of the open banking platforms, Plaid, Tink, Trustly, there's a whole bunch that are very focused on pay by bank as a use case that can be sort of better enabled through open banking as a way to link your account without having to type all that information in manually. So it can make things better. Maybe it'll even become that much better if the CFPB is able to encourage open banking to evolve into the direction of on-device authentication. So you don't even need to use your login and password for your bank account. You can just authorize it through a click on your mobile phone. So there's ways to make it better and smoother, but right now it's a little clunky. And ultimately, when I think about it from a consumer perspective, what do consumers want when it comes to this stuff? I mean, most people like credit card rewards if they have credit cards. Most are not point optimization freaks. We love you, Kia, but like most of us are not sort of where you are on that. I think some consumers, including me, like discounts on large recurring transactions. I actually pay my Visa bill with Pay by Bank because Verizon gives me a fairly substantial discount on my Verizon bill every month because I pay by bank. So that one is okay. But for more recurring transactions where I'm more aware of what I'm doing, I think I might prefer to actually make a payment with my card for a number of different reasons. Again, fraud and chargebacks and how do disputes work if I pay by bank? Those are all things that are a little uncertain to me. So I don't know, Jason. I mean, I just gave you a whole bunch of I don't know. I don't know how to feel about pay by bank. How do you feel about pay by bank?
Yeah, so this is an interesting question, particularly like straddling the US world, which is most of what we talk about, and like actually living here, specifically in the Netherlands, because this isn't even like an EU-wide thing. You've probably heard me prattle on about Ideal previously, which is like the bank-to-bank payment network
Yeah.
mechanism here. And I use it for 100% of my e-com transactions, online transactions. If I stop, caveat like this is, anecdotal, may not generalize, blah, blah, blah. I hate it when people use their own examples, but I think this actually illustrates, I think it illustrates everything you've just described perfectly. It's like, okay, if I look at my array of payment choices here, really there are no credit cards, although I did actually get the Dutch KLM Amex, but almost no retailers except Amex. So generally, like that's not even a consideration. And then if I'm paying online, you can pay with debit. There's no rewards. So there's not
No.
necessarily an incentive to pay that way. And then if you think of the UX, okay, the UX setting aside like Apple Pay, but if I'm, old school typing in, the 16-digit number, expiry, blah, 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 kind of cumbersome.
Yeah.
Whereas the way that Pay by Bank works here, let's say you're buying something on your laptop, you navigate to the payment screen, you pick you pick your bank from a drop-down menu because there are so few banks that actually is a feasible UX. Obviously, that would not work. That would not work in the US.
Well, the number of First Republics would just make that untenable for us, I think. Yeah.
And then it displays a QR code that you scan with your phone. It pops you into your banking app and you click accept or decline. So the UX is actually easier than dealing with I always have my phone with me. I do not always have my wallet with me, right?
Right.
So
right.
The UX is actually better, and then there's no financial incentive in the form of rewards or points to steer me to using some other card. In the US context, I have all the issues you have, where it's like, well, I mean, I get points on my Sapphire. Like, why would I do Pay by Bank unless you're giving me some discount, some reward, some incentive to do so? I will say, your point about disputes, I've experienced 2 stories here in the Netherlands.
I was going to ask you about that. Yeah.
I'll tell the funnier one. I don't know what this says about me and my life choices. I ordered a Domino's pizza because it's one of the only ones that's open late. Actually, I'm pretty sure I was working on some breaking news thing, and I had just flown back from somewhere, and I'm like, I need Domino's. And I ordered it, and I pay with Ideal, and then it never comes. And they call me and they're like, oh, well, we already closed. I'm like, but the
Right.
money's already gone from my account, and I still haven't gotten those 20 euros back. Eventually, I just gave up. So yeah, there is no dispute mechanism in the payment network. You can only do it with the merchant, which in this case, complaining incessantly to the Domino's in Utrecht did not get me my 20 euros back. So if you're listening, Domino's in Utrecht, I still want my 20 euros.
That is interesting, right? Because I've been trying to sort of stack rank, and obviously all consumers are a little bit different, but I've been trying to figure out like, what would people care about most, right? And I think that the convenience one, that's a solvable problem, as you pointed out. Like typing in your card number, that's something we're used to doing, but it doesn't mean it's not annoying. And people still have to do it a lot. It's not that much different than typing in your bank account and routing number. It's certainly not different at all from a user experience perspective than logging into your bank account. Like you can get to parallel pretty even there. And then if you do more of that bank to bank, app to app integration, you can actually get a lot further where you're just authorizing it on your phone. Boom, it's done. And I think we're actually close-ish to that. So I think the convenience part can be solved for. But convenience is number one because like we see it all the time with consumers. You always gravitate to what's easier. Always, 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 if you can. But after that, it does get kind of tricky because it's like, I'm not a huge rewards optimizer, but I like my rewards. So I have a hard time in my brain thinking about like when Verizon tells me, hey, you can get 5% off your bill versus like I get X amount of points on this transaction. I don't do the math quite that clearly in my head. Again, Kia, I know you do. I'm sure there are other people who do, but like the psychology of getting a discount versus getting a reward is kind of interesting to me. And I wonder if we will see merchants either in a collective fashion or individually move towards rewards and like giving a carrot rather than like, I don't know what the analogy is for a discount. It's not a carrot. It's something else. Broccoli, maybe. I'm not sure. Like, I think that psychology is an interesting choice. And then to your point, I do actually think we a lot of times underplay the importance of safety. I was just going back. I read a book recently on the founding of PayPal. And one of the parts of it that was really interesting was they were talking about eBay in the early days. And I guess I had kind of forgotten this. eBay was the biggest website in the world in like 1999. And at the time, they intentionally basically said, we're not going to do anything with payments. So you guys can find each other, buyers can find each other, sellers can find, like, you can all connect on this platform. When it comes to payments, just figure it out. They had no opinion on how payments should work at all. And so people were like sending each other envelopes of cash in the mail. They were sending like, wire transfers from their bank. They were sending checks. I mean, it was just a nightmare. And as you might imagine, there was all kinds of like fraud and all kinds of things happening as a result of that. We sort of take for granted how safe we all feel sort of interacting online in an e-commerce setting, largely, I think, in the US because of the card networks and sort of the work they've done to make consumers feel safe in that regard, plus, companies like PayPal. I don't know that safety thing is going to be super easy to just solve day one overnight with Pay by Bank. And I'm honestly not sure what that's going to look like. Maybe it's regulators sort of reopening Reg E conversations, which I know is something that like banks do not want to have happen at all. I don't know what the outcome is going to be, but if we move to Pay by Bank, they're going to have to solve the safety thing because you can give me all the rewards or discounts you want. I'm not doing this if I have to try to get 20 euros back from Domino's. Like, that's not going to happen.
Yeah, I mean, I think to put a cap on it, I think the recurring touch points are the logical place to try to deploy this, right? So your Verizon example, I would imagine most people are familiar if they have a mortgage or, most rent payment is probably through some kind of ACH transfer. I remember the last time I paid a utility bill in the States, it was a surcharge. You could pay by card, but then it was like a surcharge. So I mean, there were sort of different incentives to sort of steer you to the preferred method. I mean, the Uber...
Yeah, surcharge is another mechanism. Yeah. That's the stick they're hitting you with, yeah.
The Uber example is interesting. I mean, the screen caps I saw people post were like 40% off your next 2 rides. Obviously, this is like very specific to that example, but it's like, well, is that a strong enough... I mean, I get the strategy of like, can I get somebody to switch to bank and then maybe forget that they've done that? So I basically paid 40% of 2 rides to get them to switch.
To save and hopefully all that money for all future rides. Yeah.
So I'm sure it's a test and they'll, do their analytics and see if it works or doesn't work. But in my mind, pairing it with high use recurring transactions. Can you get me to shift my Netflix? Can you get me to shift my Spotify, my Starbucks wallet refill if I had one, to this mechanism versus, debit rails, credit rails? And then what are the right, I suppose, combination of carrots and sticks and maybe broccoli to make that happen? And I
Right.
imagine it's going to be a very interesting sort of, I can't say evolve without laughing now, but evolution, like as this
Yes.
unfolds, particularly against the backdrop of, potentially Durbin 2.0, of Visa
Yeah.
MasterCard settlement, of
Which maybe is going to get tossed out. You see
yeah,
that? That
I
was
did,
like
I
breaking
did.
this morning. Yeah. I mean,
Mhm.
the big retailers, Target and Walmart, are not so happy with the settlement. So, no, I mean, like, there's that. There's faster payments in
Yeah.
the US. Like, there's all of these converging things, and pay by bank kind of sits in the middle. But to your point, if you go and look at what Chase is doing, they're focused on pay by bank for large recurring transactions. And unless built gets you to spend your rent on a card rather than on, pay by bank, like, everyone is fighting over every single one of these transactions. So I'll be very curious to see how that all plays out. Jason, you have another story for us that might cause me to like flip out at the end of it. So why don't you go ahead?
Yeah, I will try to not make you flip out. So there's some recent coverage of a federal piece of proposed legislation around earned wage access. And I was actually, I'll admit, I was a little confused when I saw this because this piece of legislation was introduced back in February. But I guess the current sort of news cycle about it is because it was like advanced in committee or something. But I will briefly summarize some of the elements that the bill addresses, which include both employer integrated and direct to consumer EWA or earned wage access programs. So, I mean, I think some of the main things were, and this is where you're going to flip out, excluding voluntary tips and donations from the definition of a fee. However, such tips or donations would be subject to certain conditions, certain restrictions, like explicitly exempting certain service providers like payroll to make sure that they
Yeah.
were not like caught up in being considered EWA providers. Employers that, I also can't say directly without laughing anymore, employers that directly offer such services. So my
Yeah.
interpretation would be like, if I work for whatever, Chipotle, and Chipotle is giving that to me without some third party like a Daily Pay or One
Yeah.
or whatever. Financial institutions, so banks, fintechs that are doing like 2-day early pay would explicitly be carved out, not considered
Right.
EWA. It
Yep.
extends sort of ECOA-like protections, so no discrimination on race, color, religion, national origin, sex, pregnancy, marital status, or age. Given that it's not credit, ECOA Reg B wouldn't automatically apply. So, like making sure that those sort of comparable protections are baked in there, ensuring a customer dispute process. I think you get the gist, and you also, I assume, read the article.
I did.
What? So I feel like the tips and donations piece is what you're zeroing in on.
Yeah. Okay. I'm going to try
But
not
you
to
got some
rant too much
flack.
because
You got some flack
I
about yeah.
did. I did. Yeah. I mean, so I wrote about it in the newsletter, and really, like, I wrote about this advancing legislation specifically because I wanted to rant about tips. So, like, I was sort of looking for any reason to just become unhinged in my newsletter. And I will say, the people who have disagreed have done so in a very respectful way, which I deeply appreciate. Thank you so much. Jason, I hate tips in fintech. I just hate it. And I can't, the thing I need some therapy on is that I don't know if my hatred of it is just an allergic reaction that's personal to me, or if there's some broader thing happening that is maybe problematic. I mean, obviously, the tipping as a business model in fintech is not brand new. We've been doing it for a little while. I think there have been some particularly egregious examples of how tipping has worked in the past that has been smacked down. I think I could probably get you to fly off the handle on a rant. Maybe we'll do that a little later as it relates to a specific provider that has used a tip-based business model. So there are like bad business practices around tipping where you sort of pretend it's a voluntary fee, but it's actually not, or you monkey around with the user experience using dark patterns so that it's like 80% of people tip us $10 or more, or if you want to tip zero, you have to click 5 different screens in order to enter zero rather than just picking a default. So there's some tricky things you can do. There's also some emotionally manipulative things that you can do. I saw a example. I'm not sure if Dave, the neobank, does this anymore, but they used to, at
The
least,
free
which was
lunches, the lunch program thing.
yeah,
Yeah.
the free lunches. And like, they would say, part of your tip goes to providing free lunches to poor children. And if you like gave them a good tip, they would show like a happy girl with pigtails. And if you did zero, they would show like an empty plate and like, I don't know, play sad trombone music. Like it was really bad. It was like pulling on all your heartstrings trying to get you to do this. And I guess the thing about tipping, setting aside some of those tricks that you can do, which I will say the legislation you're referring to did explicitly put some restrictions around those tricks that you can do. So at least Congress seems to be aware, and I think this awareness exists at a state level too. Like if we're going to allow for voluntary tips, we want to limit the amount of like monkeying around you can do with that. But even having said that, there's something sort of intuitively disturbing to me about a voluntary fee that's not a fixed fee. So you decide to pay what's fair as a consumer. And there's just like kind of a weird psychological issue there because from a secondary order effect, like who is most likely to pay a tip and who is not? And going to your point about ECOA, are a particular group of protected class citizens more likely to pay a tip? Are they more likely to pay a much higher percentage of the overall tips that get paid on the platform? Like, I don't know the answer to that, but I could see that being true. I mean, the thing that is weird to me about tipping as a business model is if it's not bad for consumers, if consumers don't tip very much or they don't over tip or they don't tip all the time, then it's kind of a rickety, unstable business model or revenue source for businesses. And so, like, the pro-consumer argument for tipping is kind of the anti-business argument. And then if you say, well, no, actually, like, 70% of our customers tip every time, and they actually are very generous in how they tip and whatever, then what you're telling me is, okay, so some consumers are paying a lot more potentially in fees than they might pay if you just told them explicitly what the price is. And that's kind of the anti-consumer pro-business argument for tipping. And I've had some folks sort of try to make the case to me that no, tipping kind of sits in this beautiful middle area where everyone's incentives are aligned. But philosophically, I just kind of can't get there with it. I'm willing to be persuaded with data, but I haven't seen data that persuades me yet. Where do you come down on this?
I also hate tipping. I mean,
yeah, I'm gonna drag you into this.
I know.
I think you've been trying to stay out of it, but
I think there is something revealing in that as far as I'm aware, it may not be all, but all the ones that immediately come to mind that use this model target like low income / bad credit consumers, right? I don't see anybody like offering a Robinhood stockbroker app where I tip or a cash flow underwritten credit card where I tip. It's like, no, pretty much exclusively the companies that do this are offering a small dollar short-term loan. And by extension, my cynicism automatically kicks in because it just feels like an end run around state usury caps. And there's an entire other discussion, and I've had it with plenty of people plenty of times, about the usefulness of APR in measuring, short duration loans. And I'm actually like fairly sympathetic to that argument in that an APR that says 400% is not very meaningful to your typical consumer. Whereas telling that consumer you are paying, and I think this is how Vero structures their small dollar products, you're paying $10 to borrow $200 for 2 weeks. That's much more tangible than this sort of like abstract percent number that's like more than 100%. However, like you can hate TILA, but it is still like the law.
Yep, it is.
And so when I see, the dependence on tips, and or expedited funding fees or donations or what have you.
Donations is another one. Donate to our cause. It's bizarre. It's just the metaphor drives me crazy. Like it's not tips, donations. What are we doing here? This is a business. But anyway, keep going.
It feels like a very obvious and not particularly sophisticated arbitrage on not having to disclose an APR and not violating or appearing not to violate state usury caps. And I mean, we've talked about this plenty of times. Like I worked in the smaller dollar space. I understand it is a very, very tough business for a lot of reasons. And generally speaking, I think sort of more options and more competition is generally a good thing. I do think The tip model is generally disingenuous. And also, like, it makes it hard, if not impossible, for a user to meaningfully compare cost of credit, particularly beforehand, right? Like, if I'm looking at two
Yeah.
websites and one, is a classic payday lender and they say this is going to cost me $30, and one is, one of these cash advance apps and it says it is free, which one am I going to pick?
TruStage Payment Guard Insurance is a first-of-its-kind insurance solution built for digital lenders, designed to help you attract more borrowers, strengthen your loan portfolio, and reduce time spent on collections, all with minimal tech lift needed to go live. To learn more about Payment Guard Insurance, visit www.trustage.com/payment-guard and speak with a member of the TruStage team. You're absolutely going to pick the free one. And, it's really tough because, this kind of ties into the broader, I've seen this described as tipflation, where since COVID, you go to a coffee shop and they're like, yeah, would you like to tip 35%, 40%, 50%? Would you like to just double the cost automatically? Like, what choice would you like to make? Like, we like your dog that you have tied up outside. Maybe you could just give us your dog. Like, it's getting a little out of control as it relates to tipping. And, I was thinking about it in the context of like restaurants, because people are like, well, if it's bad, you just won't tip, right? Like if you're unhappy or whatever, it keeps our incentives aligned because people won't tip if we're not delivering a good product or a good experience. And I was thinking about that in the context of my day-to-day life. I never don't leave a tip, right? Like the psychology of asking for a tip is, oh, I'll just always give you 15%, right? Or 20% or whatever. Like I can have the worst service ever. I don't think I've ever not left a tip. And I don't think that's uncommon. And so this idea that it can be this sort of perfectly aligned incentive that keeps everyone honest, that's not quite how human psychology works, at least not in the real world. Now, again, apps might be different, financial services might be different, but when you call it a tip and you tie yourself into the existing psychology of how this payment mechanism works for consumers, you are sort of transposing a set of values and cultural norms on that way of paying that I think produces an outcome that's generally good for the business. And I'm not sure it's great for consumers. So anyway, I continue hope that maybe this will happen. Can I ask you a non-tip question about the EWA stuff?
Yes, you can.
Okay. So as I think listeners may know, EWA is a focus of intense lobbying battles at the state level. Pretty much every US state is either in the process of passing new legislation to address EWA, or they're at least entertaining visitors from varying lobbying groups, trying to persuade them to take one side or other in the EWA debate. And again, as you mentioned, it's kind of weird because you have employer-linked EWA providers, and then you have sort of standalone direct-to-consumer EWA providers, and the lobbying sometimes gets combined in a way that's a little bit confusing. But all of this is happening at a state level to varying effects. Some states are passing kind of more pro-EWA legislation. Some are passing slightly more sort of, I guess, consumer-oriented EWA legislation, and it's sort of playing itself out in real time. I had a thought, and I think I'm wrong about this, that this legislation, which, as with all federal legislation, stands zero chance of passing because our democracy is broken, if it was to pass, would sort of presumpte or sort of sit over top of these state laws and sort of provide a single federal framework for how this needs to work. Is that true?
This is why we can't have nice things, Alex. My understanding, and unless the bill has been marked up or changed since February, it does not include a measure that would specifically preempt different or more stringent state regulations. So, for example, I think like California is like the problem state. I think also like I'm putting that in air quotes, but like the one that like you've had a lot of states say either, we're not regulating this as credit, but you need to get a license, something like that. California has gone the opposite direction and said specifically like, oh yeah, we are going to call this credit under California law. So like it is a loan, it is credit. So relevant, California licensing and related lending regulations would apply. And interestingly, the CFPB filed a comment letter in support of California's position, which I'm getting like
shocking.
I am relatively new to like watching this whole sort of like regulation sausage making unfold, but like seeing the FDIC like chime in on this Colorado case was like weird.
Yes.
Seeing the CFPB weigh in on that California proposed reg is like, oh, okay.
It is weird.
This is telling you something very interesting about the position of the federal regulators in that they're like writing these, whether comment letter or amicus briefs in support of certain positions. So, but no, my understanding is it does not preempt state regs. So in a sense that I guess it could make
What's
it
the point of
worse?
federal legislation that doesn't preempt
no.
state level? I mean, it's such a funny thing where it's like, we're going to weigh in. And actually, I mean, to your point earlier, it's fairly thoughtful, I think. Like they cover a lot of ground. They make a lot of distinctions. They carve out a lot of stuff. Like they clearly did the work to like understand this product category. And then they're like, yeah, but if states want to do their own thing, that's fine too. It's very weird. I don't know that we're going to get to a great place on EWA from a regulatory perspective, at least anytime soon.
If I'm wrong about that preemption thing, tag me and Alex on Twitter with a correction. I'm sure somebody will. But that's I asked around when I wrote the original analysis in Feb, and the people I spoke to said it did not preempt state reg, or it wasn't built into the bill that it would preempt state regs.
Well, if that's incorrect, just slide into Jason's DMs. He loves it when that happens, particularly if you're
politely.
A lawyer, so just
politely.
Yeah,
politely.
Just do it politely. That's all we ask. Jason, do you have time for one more story?
Yeah, I have time.
Okay, so we were talking about your history in small dollar lending, so we have to talk about ISAs for a second, at least. You wrote about a consent order between the CFPB and BloomTech, previously known as Lambda, and its founder, Austin Allred. The order permanently bans BloomTech and all consumer lending activities and bans Allred specifically from any student lending activities for 10 years. The CFPB is also ordering BloomTech to cease collecting payments on these ISAs or income share agreements for graduates who did not have a qualifying job, eliminate finance charges for certain agreements, and allow students the option to withdraw without penalty. They are also paying civil penalties, which will be deposited into the CFPB's Victims Relief Fund. So, just by way of background, for those who don't know, BloomTech offers essentially these kind of coding boot camps that would allow for students who go through them to become, theoretically, qualified for jobs in computer science, in the tech space. And this innovation, again, possibly in air quotes, was very, very sort of widely lauded when this first started becoming a trend. I don't know, Jason, 3 to 5 years ago, somewhere in that range?
There were, you had General Assembly. There was a whole boot camp era where there seemed to be a bunch sprouting up.
Yeah, there was. And it's, you can kind of understand the sort of affection for this category, just given that student loans and student lending and the cost of higher education is a nightmare. I think this was also around the time that just tech as a category was exploding. All the most profitable companies were tech companies. A ton of VC money was flowing into tech. So getting a job in tech was specifically seen as a really great path to wealth management. Now, I think today it's more you should start an HVAC company and then get acquired by a private equity firm. But at the time, getting a job at Google was seen to be a good thing to do. And so these coding boot camps popped up, and ISAs, or income share agreements, were a mechanism designed, again, sort of repeating our language here, to align the incentives of everybody involved. The basic idea, and ISAs are not new, as you pointed out, and I thought this was hilarious. Bill Clinton actually got an ISA from Yale when he was going to, was it law school?
Law school, yeah. In the 1970s.
In the 70s, right. So this is not a new concept. But again, as with everything in fintech, we sort of rediscover these ideas. And we're like, ooh, we could apply technology to this. So the idea essentially with ISAs is that you pay a price, and actually a slightly higher price, to enter into one of these boot camps that is funded through an income share agreement. So they will pay for that tuition, essentially, for that program. And then when you graduate, you will be charged a percentage of your income if you get a job in a field that is relevant to the boot camp that you went through. So if you end up getting one of these great coding jobs at Google or elsewhere, you then make payments as a portion of your salary. Again, if your salary meets certain requirements, I think it was over $50,000 if I'm remembering right. And you make payments until either the amount that you owe is paid back or until you reach the end of the ISA period, which I believe was about 5 years. And if at any time you don't have one of these jobs, or if you lose your job or whatever, the payments cease. And so it's a very strange mechanism particularly when you compare it to loans, because while it does sort of have the same general shape of a loan, we're giving you money, you're going to pay it back later. The details vary a lot in terms of what you're allowed to collect on, how much the consumer pays. Comparing this just in terms of APR, ISAs would not come out looking good in that regard. But you can also see how ISA providers are taking a much greater risk potentially because they might end up collecting zero and have no recourse to try to collect on it. So, interesting model. Where BloomTech got into trouble primarily is that they were not honest at all in the way that they were describing or marketing these products. So there was sort of UDAP problems all over the place. They described ISAs on their website as being risk-free. They claimed to have a job placement rate coming out of their boot camps that was significantly higher than it was. They also, I think, made it seem like those job placements were just sort of something that happened because their graduates were in demand, where in reality, I think it was much more likely that they were actually manually trying to place these candidates into jobs and doing everything they could to do that. All kinds of sort of marketing and deceptive acts type stuff happening. Jason, my read on this is that it was those sort of regulatory issues, specifically around UDAP and TILA and sort of the associated violations, where most of the problem came from. And this isn't necessarily a condemnation of ISAs overall as a category. Is that how you read it?
Yeah, that's exactly how I read it, right? I guess I did not realize quite how big of a Twitter Silicon Valley celebrity Austin is.
You have a connection to him specifically.
He filled my role after I left LendUp. I did not actually meet him, although I've chatted with him once on Zoom in the years since. I mean, you can understand the appeal of the story. I mean, the narrative is amazing, right? Poor kids, few opportunities, don't want to take on all these, student loan debt. This is the perfect combination of things. We're going to train you for a tech job, and we're going to finance it with this somewhat novel income share agreement to make sure our incentives are aligned. And to your point, Alex, it's like the ISA, I think it's easy to paint it with a broad brush as either being, good or bad, when the reality is it really depends, in my mind, one, on the design of the ISA product itself, right? So what is the minimum income threshold that it kicks in? What percent of your income are you paying once that begins? What is the cap of how much you're going to repay? Some of these disclosures before the fact, which Lambda/BloomTech, definitely appears not to have done an adequate job of as far as describing it as risk-free and saying, we don't get paid until you get paid. That's where a lot of the problems came from. And then the second piece is making sure that that funding, that debt that a student is taking on, is actually increasing their earning potential, right? Because the idea here, whether you're using it to go to a university, and I think Purdue in Indiana is actually running an ISA program as well.
They were. I think they've stopped since. But yeah, they had Boilermaker loans basically that were, ISAs sponsored by the university.
Is the idea that it is going to increase your earning potential. And I think another potential issue, based on, there's quite a bit of reporting separate from the CFPB case around Lambda/BloomTech, was that the quality of the instruction was not very good, or at least maybe at some point in time was not very good, as far as using material that could be freely found on the internet, or relying on, so-called teaching assistants making a minimum wage who didn't even understand the material they were teaching. So you can see, if what you've designed is a for-profit program that is offering relatively low-quality instruction financed through ISA, it's not surprising to me that that might have a bad outcome. I think, it's important to caveat, I saw anecdotal folks on Twitter saying, BloomTech changed my life. I wouldn't be where I am now without it, et cetera. So I don't want to paint it as a universally negative experience. And linking back to our earlier topic, I fully believe that Allred and the team, were well-intentioned. But again, that does not excuse either violating the law or not making disclosures that would have helped these students make a more informed decision about what they were doing. And I think in some of there's some Twitter swirl about this, and a lot of it sort of immediately defaulted to well, universities are really expensive and federal student loans are bad. And you know what? I don't disagree. I don't disagree with those
No.
arguments, you know? Like,
Yeah.
there's an entire separate conversation about how messed up and broken the federal student loan system is, where, actually an income driven repayment plan on a Fed student loan ends up looking a lot like an ISA, but in some ways, like worse, because you could be getting interest capitalized back onto the loan. So it's like reverse amortizing. Eventually it gets forgiven, but then technically you have to pay income tax on the forgiven loan. So by no means am I, up here saying like the United States higher ed and higher ed financing is like a functional system. But I mean, I think in this narrow example, like boot camps could work, ISAs could work, not in the way that they did them in this particular case is sort of where I land.
Right. No, I think that's exactly right. And I think that there's a challenge associated with the category, and then there's a challenge associated with this specific example. And I think you nailed it. Like in this specific example, it just wasn't done very well. And in fact, it's interesting because BloomTech has since stopped the ISAs. And so they no longer do that. That's not a part of their business anymore. And so clearly they've sort of backed away from this while they continue to sort of try to attack this broader mission that they have. The thing that's interesting to me, and it ties back into earned wage access as well, is there's this weird problem we have in the US where we'll say, all right, so this particular thing doesn't work very well. Like workers should be getting their pay as soon as they earn it so that they can smooth out their cash flow. It's not really a loan, but the only way to offer this is either to offer it as a loan, in which case you're subject to regulation and requirement that doesn't really make it very easy to do, or you find tricky ways to get around that regulation. And then in the case of higher education, you go, okay, well, people need a different path to getting these jobs and becoming qualified for these jobs. It doesn't require them to go through this entirely messed up system that we have for higher education financing. It's not really a loan, but, and this is where the CFPB's analysis comes in that I think is really interesting. The way the CFPB looked at this, they applied a lending framework to this category of product being offered, right? They called the difference between what you paid upfront if you paid in cash for one of these programs and what you paid if you financed it. They called the difference in that amount, which was roughly $4,000 on average, a finance charge. And I can understand why they did that, because that, if you're dead set on comparing loans to ISAs, that would be the equivalent of a finance charge. But they didn't really take into consideration that like the back end of how you service and collect on an ISA is completely different than a loan that has a finance charge. And so calling it a $4,000 finance charge without also explaining all the things that are different, maybe in ways that are worse. And I've been very critical of ISAs in the past as a category, because I do think they are sort of a little bit exploitative of someone's future earning potential. They do this in home equity too, where they'll buy your house from you without giving you a loan. And it's a similar concept where they're essentially taking the risk to buy all of your upside from you. So I'm not necessarily in love with the model, but I don't think it's also intellectually honest to say this is a loan, because it's not really a loan. It's something else, better or worse. It's different. And so I will be very curious, much like EWA, to see, do ISAs continue to sort of persist as a category? Are there others who are going to try to keep sort of innovating on this model that goes back, well into the past? Or are regulators just going to sort of scare people away from trying to do this at all? I don't know the answer to that, but I think it's an interesting question.
Definitely one to watch. I mean, I think they're, particularly with the current sort of CFPB and certain state regulatory postures, a number of like disincentives to try to pursue that model right now. Yeah, it's like
any innovation in lending is like, maybe don't.
I think my biggest challenge with it is like, it's kind of a weird product as you get at.
Yeah.
I mean, I think of it actually, my mental model is like a loan with like credit default insurance attached to it.
Right.
Where it's like, well,
right.
If you can't pay, it eventually just goes away. But the real challenge is like explaining this to consumers who may not understand how it works or not understand the pros and cons versus a more traditional, more familiar financing mechanism. But I guess we'll have to wait and see.
Yes, we will definitely wait and see. Jason and I have tried to add nuance throughout this whole podcast to the good versus bad element, which I think actually is a nice way to tie things up as we do our Can't Let It Goes before I let you go for this podcast. So, Jason, what do you have for us?
Okay, this ties it all together. Good actor, bad actor,
It
tips.
does. Yes.
I cannot let go that my favorite fintech small dollar lender platform, Solo Funds, is now in its like second or third week of an outage, which appears to be precipitated by transitioning from Synapse and Evolve to Treasury Prime and Bangor. So it really
Ah,
ties the entire show together.
it ties everything together. Yeah.
Yeah, it's the interaction between the company, whatever poor person is running their social media, and users on Twitter and on Facebook has been excruciating to watch. I mean, these are like real human beings at the other end of this who came to depend on the ability to borrow small amounts of money, and then with zero warning, zero information about a, technical transition, we're no longer able to do so. And I mean, setting aside my dislike of Solo Fund's model, which uses tips and donations, I think the lesson, the takeaway is more around change management and business continuity, which I've just made this
Yeah.
very boring and banker very quickly. But it's like, if you are, even as a non-bank player with bank partners, if you are executing a technical transition, you need to be adequately prepared to do it correctly and adequately prepared should things go awry. And I mean, even, and this is quite a while ago at this point, but Rush Card, which is like a prepaid debit card, had a somewhat similar situation where users were left unable to access their funds for like a week or longer. And I reread the order over the weekend, and that was one of the exact points. It was like it found, I think in that case it was MasterCard plus Unirush, the parent company. Their inadequate testing prior to rolling out the transition was deemed an unfair under UDAP business practice.
Sure.
So yeah, even if you're a small early stage fintech, if you have live customers in production, you need to be able to execute technical changes competently. Let's go with that.
Yes.
Okay, that's it.
Yes.
I'll
Okay.
stop.
Well, I like that one. My Can't Let It Go also, I think, ties much of the show together. Mine is a little while ago, as you may remember, seen in Jason and I's newsletters or on Twitter, Mercury, the business bank provider, they introduced a personal checking account for founders. And it's an interesting product. I think I covered in the newsletter, Jason. I think you've talked about it a little bit as well. It got coverage in TechCrunch, and the title of the article in TechCrunch was a little long. It basically said Mercury, the B2B banking app, which is in the midst of some regulatory challenges on the B2B side, launches a personal account for founders, something to that effect. And setting aside the fact that it's a slightly unwieldy headline, it's a pretty fair headline. And if you read the article, pretty fairly written by Marianne over at TechCrunch. As she correctly noted, they are launching this product with a bank that has been going through some BaaS Island related drama. Obviously, Mercury, as Jason mentioned at the top, is still engaged in a legal dispute with Synapse. So everything that Marianne noted as context for Mercury launching this very cool product for founders that founders seem to really like, all very, very true, very fair. I thought the article was very fairly written. That did not stop a lot of people on Twitter, tech Twitter, from basically saying, I think I'm getting this pretty much verbatim, apparently TechCrunch really does hate startups now. And I got to say, man, I've seen this attitude crop up a lot, particularly recently on Twitter, where there's this idea that the mainstream press, which by the way, TechCrunch is not the mainstream press, but let's set that aside for a second. The mainstream press hates tech companies and is actively rooting for them to fail. And that is A, I think not true. And B, it is so incredibly indicative of how much babying the tech industry has had for the last like 20 years, right? Because this whole industry kind of comes out of nowhere, whatever, 20, 30 years ago. It becomes a major part of the economy. And the first act of it is, wow, this is so exciting. This is so cool. Look, we have cars that we can summon with our phone. Netflix is amazing. Google is unbelievable, blah, 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 blah. So like there's this great sort of optimism boom that forms around tech. And most of the press coverage for years and years and years was just like, outrageously optimistic and cheerleady for the tech industry. And it couldn't have been more that way. And now TechCrunch, which, by the way, is one of the most pro-tech publications you're ever going to find. Like, they could not be more in love with tech companies and startups. They love startups. Now, just because they're adding a little bit of context into their articles and into their headlines and doing just a little bit more of that sort of balanced storytelling, which is what their audience, including me, really wants to see, and they're doing a great job. Now they hate startups? That is like wild to me. The tech media persecution complex that exists, which is, I think, more bad in sort of a general tech ecosystem. And in fintech, people are slightly chiller about it most of the time. My God, is it just out of control? I can't take it, man.
I will say that it occasionally astounds me how thin-skinned some folks can be, where, a little bit of criticism and it's just like, well, obviously you hate everything.
Right. Well, like Marquise Brownlee was going through this, the tech reviewer, when he gave a bad review to the Humane Pen, like, what do you want him to do? Like, it's his job to tell the truth and to give context for it. And actually, it's not even, he's going out of his way to be like, it's really bad so far. It might get better in the future. I can see what they were trying to go for. Like, it probably was actually a much nicer review than it needed to be. But boy, if you do anything except like praise, it's a hit piece. It's bizarre.
I mean, it's easy to love the media when they're telling the story that you want them to tell. And then when that relationship shifts, it's easy to no longer love the media, right?
Yes. Well, I mean, I guess you have the benefit of just like, you've been going through this for a long time, so you probably are very, very used to this. I feel for the folks at TechCrunch being like, what are you talking about? We love startups. We love them so much. So anyway, Marianne, folks at TechCrunch, please keep doing great work that you're doing. Jason, you keep doing great work as well. And can I count on you coming back next month?
Yeah, I will be back next month. Hopefully your snow will be melted.
I hope so. We don't really have spring. We just have winter until summer arrives. So maybe by the time we chat, it'll just be summer. I'll let you know.
Sounds good.
All right. Thank you, sir. Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.